Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
Well, it does kind of feel like 2021, at least some vibes, with meme stocks and crypto back in the spotlight. Kohl shares more than doubled amid an influx of mentions by retail traders on social media, with the stock price soaring as much as 105% when the equity market opened today. And then there's Opendoor Technologies. It jumped as much as 120% yesterday. It extended its gravity-defying rally from last week. Investors continue to pile into the stock that has found a sudden fandom among retail traders and social media platforms.
I mean, this is one that is certainly on our radar. One of the reasons Opendoor has been moving is due to Eric Jackson. He's the founder of Toronto-based hedge fund AMC Capital. He made a series of posts on X encouraging buying. And Eric joins us from Toronto on this Tuesday. Eric, good to have you here with us. Do you, first of all, take issue with this being Opendoor, a meme stock?
Yeah, I think, Carol, that all the meme stocks from 2021 were dumb businesses. I couldn't understand it at the time, why retail traders were getting so wrapped up in AMC, GME, and BlackBerry. I think those were the big three. Those are all like Walking Dead businesses. So when I got into Opendoor, and then I first started tweeting about it last Monday. It's hard to believe. It feels like a century ago, like 2:45. Like I got into it because this is a real business and it's got a real platform that it's built, and it's definitely fallen on hard times. That's why the stock's down like 99% or whatever it is from its all-time highs. But I just think that the market got overly pessimistic about it. And I've seen this movie before with Carvana. Like that's one of my greatest heads on my wall, I guess, from the past, is that I got into Carvana early. Not at $3.50, but at $15. And today it's like close to 400. And I just see so many similarities between these two businesses. And all, people just get overly prisoner of the moment, pessimistic about these companies, and everyone's negative Nelly, and everyone loves to dance on the grave and say that these companies are circling the drain. And nobody would have believed that, at 350 that Carvana was going back to 400. Mm-hmm. Nobody can believe now that at it was 70 cents last Monday. Now it's whatever it is, $3 today, that this thing is, I think, going to $82.
Yeah. Well, okay. So let's talk about that. It's $2.80 right now, down about 13% as we speak, just on the day today. You have a price target of $82. That's pretty wild. Make your case to us on why you see it moving that high.
Well, I mean, I'll be even wilder, Tim. I think today it should be trading at $40. Basically if you go back and look at Carvana, okay, use this as a comparison to Opendoor. Both of these companies, they're trying to e-commerceify some niche that hasn't been e-commerceified before. For Carvana, it was buying and selling used cars. For Opendoor, it's buying and selling homes. It's a huge business, obviously, in both cases, a national business. Where just having like 1 or 2 or 3% market share nationally, is talking billions and billions of dollars and power, because it's all so fragmented today. With the dealers in the car industry and with the agents, in the real estate industry. Basically, you need a lot of debt to run both of these businesses, and so the problem that both of these businesses came upon is that although they were flying high in the pre-COVID and then briefly post-COVID era, when interest rates were low, when Powell started raising rates, suddenly investors got nervous and these stocks crashed. And the assumption was that they're going to go under. They're going to file for bankruptcy. So they're priced as if they're going to go bankrupt. And I don't believe that's true. Carvana, in fact, I was on a podcast in June of 2022 with Josh Brown and Michael Back, where I called both, like I said, both would turn around. Carvana did, and Opendoor didn't. I was dead wrong. Like, it took a lot longer for them to get to the point where they're about to turn profitable, but they are about to turn profitable.
So for Opendoor, do you expect to inject and invest more money into it and then take a profit? Or because it sounds like you've done the research, looked at the business, maybe talked to the company, that this is more of a long-term buy and hold strategy for you? Which is it?
Well, I've been fortunate to be early on a bunch of companies. Like, I was like really early on Alibaba, even, back in 2009, 10, when it was still a private company. It was valued at 10 billion. I thought it was going to go up. Carvana, some other ones. Like, what I've learned, Carol, is that, like, it's always hard to not avoid the temptation of firing up the terminal or turning on business TV and getting emotional about the macro headlines of the day and get shaken out of these positions. And sometimes when these companies are pretty rare, that can truly 100 bag or 100x, right? Mm-hmm. But it's so easy to get shaken out of these positions. Or like in the case of Carvana, like I said, I got into it at 15. I would say I got out of it, the bulk of my position in around probably 130, 140, 150, somewhere in there. And I'm thinking, oh, I'm so smart. I made 10x my money. Pat myself on the back here, and I know this company really well. I still was optimistic about Carvana and still am today. But I thought, I'm just going to trade in and out. And, the truth is, you don't make as much money as if you do nothing and just let it sit there. So I'm not jumping in to add more, Carol, but, because I want to see how the things play out. But I'm going to try to avoid that temptation and just sit and do nothing until 82.
Can you give us an idea how much you have put into it? And is it all your money? Is it investor money?
Well, I run a fund, Carol. It's a small fund. I'll be frank with you guys. It's I had a huge billionaire that basically was like a cornerstone investor for me in 2016, 17 when I started EMJ Capital. And he said, I like the way you think, Eric. You look at companies differently. You find these little hidden jewel companies. How about I give you some money to manage? And I did, and did great. It was kind of like a Cathie Wood type arc, 2017 up to, probably February 2021 was amazing, shot the lights out. And then 21 and 22, I got crushed. And I didn't diversify my, customer base, and so 99.5% of the capital in the fund was this billionaire, and he took it out. And which was his right, and I'm still friendly with him, but I was sort of left scrambling and trying to figure out what to do, and so kept the lights on, pivoted to building a team to build AI models, but it's been hit and miss the last few years, and then it was only probably 3 months ago that I realized hey, we're doing, I keep finding these companies. Why don't we just sort of go all in on that? Let's get the AI models totally focused on finding these 100 baggers before the fact. So the remaining capital we have, which is a few million, we put in, obviously we didn't put it all into Opendoor or anything. We have other positions. There's sort of 5 key positions that I have right now: Iron, Cipher Mining, BTQ Technologies, and Ethereum. Those are the kind of the big 5 on, and we'll see where we go. And
Eric,
all I got is my reputation, guys.
Right?
And,
no, we get.
But now I've got people, whatever, calling up or emailing and saying, this is great. We want to get behind you. So we'll see where it goes.
It seems like a lot of folks on social media. A lot of folks on social media are getting behind you. Have you talked to Chamath Palihapitiya at all about this? He is, had famous involvement with Opendoor back when it went public.
I haven't talked with him. I not emailed, but I texted, or not texted. I tweeted him when this thing got started last week, because obviously I think it would be a tremendous redemption arc for Chamath to come back into this stock. I don't think he has anything to be ashamed of being involved with Opendoor to begin with, or any of the co-founders. Keith Ravoy is a guy who kind of wrote the business plan originally. I think he's one of the smartest guys out there. Everybody who was associated with this company was it was a good company. It's just the macro changed and the rates rose and stuff. And so I don't think Chamath has anything to be, ashamed of, but I think it would be amazing if he came back in on the ride to 82, which would double the all-time highs, which is previously $39.
Eric, forgive me for being blunt about this question, but if you look at your Twitter feed, there's just it's like all Opendoor. I mean, I had trouble. You're spending a lot of time retweeting and interacting with folks on there, and I understand that's part of the game these days. But maybe a critic could see that and say, "You're really trying to just pump this stock up at this point, defend it on its fundamentals, and convince people that this is not, for lack of a better term, pumping it up and then selling."
I don't know what to tell you guys. I mean, unfollow me, Tim, if I'm bugging you. Mute me or block me, and I'd say that to anybody else. I think anybody who knows me knows I'm not a pumper or whatever. I mean, I've been inundated, called a pump and dumper, a grifter. Jim Cramer said this was a parlay yesterday. I don't know what that means. You could explain it to me. Whatever. I mean, people are, they're not familiar with the Opendoor story. So whatever, they want to sit back behind their anonymous Twitter feeds and cast aspersions. I don't care. I'm here to make money. I got to feed my family. I got to grow this business. I got to do well for my investors. And if people want to take shots, whatever, I just don't have time for it. I really love the community that we've built. I mean, it's amazing. This morning I was retweeting all these people from, you name it, Turkey, Korea, Japan, Africa, Nigeria, Brazil. I mean, everyone around the world, and they're all in on Opendoor.
Yeah.
I don't know that it's going at 82. I don't have a crystal ball. I wasn't, I might be wrong. I was wrong for many, many years about Opendoor, but I don't think I'm wrong right now. I think now is the time. This thing is turning, and you can either get in, make a lot of money, or not. And I got people already telling me how much money they've made and it's life-changing and all this. That's fantastic. I mean, it doesn't help me, but I'm happy for them. And this is a community.
Eric, you did say
we learn together.
No, I hear you. You said you're hoping to hold on to it. Like, that's your plan. But I mean, if all of a sudden the stock took a downturn, I mean, it's a $2.84 stock, so I'm not quite sure what kind of downturn, but is there something that you would quickly change your thoughts, or you're going to ride it, even if it rides down a lot?
I can't say I'm going to ride it forever, Carol. I mean,
not forever, but I mean, if it went down 50%, would you stay with it?
I think it's less about the percentage drop. I mean, there's obviously going to be volatility, especially in the early days of these kinds of names. And, they report earnings in a couple of weeks. So, if it's a terrible report, I mean, the thing would have a negative reaction to the downside, and then reverse to the upside. If it was good news, I think it is going to be profitable. And I think it's going to be the start of a string of profitable quarters, which is what needs to happen for this thing to get up to 82. But one thing that's different about Opendoor is there is more diverse opinion about management. I think with Carvana, obviously everybody on Twitter and Wall Street hated it, but if you talk to people that actually knew the business, I think people really admired the CEO, Ernie Garcia, and the management team. And those guys bought a lot of stock when Carvana was low, right before it bottomed. Nobody's done that here at Opendoor, which is the norm for most of these. I mean, most times these insiders, they just don't. Brian Armstrong from Coinbase never bought a share from the time he went public at 400 down to 38, back up again. He just sell, buy a house in LA. So, but there's more controversy about the management here at Opendoor, Tim, not to cut you off.
Yeah, that's okay.
Some people think Carrie Wheeler, who's the CEO, is great, and some people don't. And so if I discovered 3 months from now that, gosh, I don't know about her. I mean, one thing I might think about is what's the chance of an activist coming in here, which I think is very high. So that might keep me in. But if I concluded the management's terrible, I can't stand it anymore, then obviously I'd have to exit. I don't think that's going to be the case.
Eric, before we let you go, other stocks that you are buying right now, that you're holding right now, what are people missing and what are you getting?
Earlier today, Tim, hot off the presses, I tweeted this out already. So this is, I bought some iron, IREN, and Cipher, CIFR. Both of those are Bitcoin miners. We make a lot of money from that, but they're more excitingly, they're kind of like a Core Scientific, and just, CoreWeave bought Core Scientific recently, but it was kind of a lousy price for Core Scientific. Iron and Cypher are way bigger, have way more kind of energized gigawatts that are coming online in the next year that somebody like an Oracle or a Meta or Google has to do a deal with. So I like those, and I like BTQ Technologies. BTQQF is the ticker. It's still an OTC ticker. I bought it at 21 cents in December. Wow. It's now at like $5. So it's been a 30 bagger for me so far, but I think it's gonna meet the criteria and be a 100 bagger when all said and done.
All right.
Always looking for the diamonds in the rough. No matter how low the prices are. Hey, Eric, appreciate you taking so much time with us this afternoon. It's great to check back in with you. It's been quite a few months, so we love it that you took the time. Eric Jackson is the founder of the Toronto-based hedge fund EMJ Capital. I would never block him on Twitter. I still follow you on Twitter.
No.
Check out his Twitter feed, too, because he does share a lot of what he's working on there as well.
Yeah, pretty clear and pretty transparent and stuff out there.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Back to a headline that you mentioned just in the last few minutes, Carol. SpaceX has warned investors that Elon Musk could return to politics. Musk may serve in similar roles to his previous position as senior advisor to President Donald Trump and devote significant time and energy to such roles. This, according to documents. It's great to have back with us Bloomberg Businessweek senior reporter Max Chafkin. Max is the co-host of the Everybody's Business and Elon Inc. podcast, also the author of The Contrarian, Peter Thiel, in Silicon Valley's Pursuit of Power. He's here in studio with us.
We
Max,
didn't expect to have you back this soon.
I feel like,
as much as we love it.
I feel like you knew something here when you told us that you never say never when it comes to Elon Musk and staying out of politics.
I mean, this is one of these things where any investor who's learning this from the risk factor statement of the prospectus is a little bit behind the curve. It's been pretty obvious for about a year that Elon Musk's political activities have a bearing on his businesses, but this, of course, is an acknowledgement of that. And also, I guess, Tim, as you're kind of hinting, maybe a suggestion that Musk has plans to re-enter the fore, although he sort of said as much on Twitter, a week ago when he launched the America Party.
All right. But does this take it to, if he's putting this language in the tender offer for SpaceX, I mean, does it kind of make it even more formal or official? I mean, does it take it to another level?
I mean, we saw these risk factors. I'm less familiar with them as they apply to private marketing fundraising, but of course they do show up in public market fundraisings as well. On quarterly reports, annual reports. I just had a quick peek at the last Tesla earnings release back in April. It had two new risk factors. One related to essentially perceptions about the stability of the management team, kind of a wordy way of saying negative stories about our CEO, and another about tariffs and a host of other things. So, I mean, I think this is more an acknowledgement of something that Musk himself has talked about. And this is not, I mean, maybe this, in some ways, I guess this is confirmation that people inside of SpaceX are aware that Elon Musk has discussed very recently plans to continue his political journey, and this is a reflection of that.
But how that journey could look might be a lot different than what that journey was over the last year or so, given the very public fallout that he's had with President Trump. Do you think it would take the form of a new political party and supporting candidates, perhaps Democrats and Republicans, who maybe want to slash the deficit?
Well, we've talked about this a lot. We've talked about this here some and also on the Elon Inc. podcast. I think there are reasons to be somewhat skeptical of a political party in the formal sense, like another effort to start like a reform party or some true alternative. I think the idea of Elon Musk somehow trying to formalize this political movement, in the same way that the Tea Party is not an actual political party, it's like a constituency of voters. You could imagine something like that. And what Musk has said is, or hinted at the very least, is a plan to back certain candidates in the Senate and in Congress, and then try to use that to be, as a sort of point of leverage in negotiations over bills and so on. And I think, there's something to be said for that, right? If he were able to, say, peel a few Republican Senate or House votes away, like that would give him more leverage over Trump than he has now. There are also reasons why this could backfire spectacularly.
All right, let's just remind everybody, as Max has been reminding us, that, he has talked about, kind of staying exposed to politics or staying in politics. We're talking about Elon Musk. In fact, here's what he had to say on May 30th from the Oval Office.
I expect to continue to provide advice whenever the president would like advice.
I hope so.
I expect to remain a friend and an advisor, and certainly if there's anything the president wants me to do, I'm at the president's service.
All right, again, that was Elon Musk there with Donald Trump, the president of the United States, back on May 30th. So, Max, if we read something like this, who knows? Is it going to be what?
Was that the day with the black eye?
That was the black eye.
Okay, I just wanted to.
That was
parenting mishap.
Yeah, sorry. The reason I ask is because you were on our program yesterday. The whole big take. It's the cover of Bloomberg Businessweek. The issue is on my desk.
Right,
yeah,
and this
it's all about this.
This is like the
no.
financial filing equivalent of a black eye, right? An acknowledgement that there is risk here and risk for his companies. Just now, as we're talking about this, Musk has been tweeting sort of semi-taunting the Trump administration over reports around the Golden Dome, reports that the Defense Department might look for alternatives to SpaceX. So he's obviously moving into a sort of different position relative to the Trump administration. I'd say it's kind of similar to the one he had with the Biden administration, although, of course, Musk's politics have changed quite a lot since then.
Yeah, I guess that's what I was curious. Is it that he's going to go back and become buddy again? Or we just don't, in what form? Or is he kind of like this and just figuring out a different involvement in US politics?
I think Musk has carved out an identity that puts him to the right of President Trump on a whole bunch of issues. You brought up the deficit, but of course he talks all the time about, identity politics, about sort of cultural issues, always, taking a more or less right-wing position, and that's kind of where his fandom is, and that to the extent that he has a political platform, I'd expect it to be a right-wing platform, further to the right than the Republican Party for sure. But of course, there's also an element of self-interest, right, where a lot of his positions coincide with the interest of his companies. His companies, as I've said a bunch of times on this program and others, are either heavily regulated by the U.S. government or dependent on government contracts. So it's going to be my guess and my supposition would be some combination of Musk's own political interests and fixations along with self-interested policies. So you could imagine very conservative on cultural issues, perhaps, but probably a little bit less conservative on the question of funding green technology companies and so on, because of course that's what Tesla is to some extent.
We'll see. I don't know.
Yeah, day by day.
Hey, this is a great story, though.
Yeah.
Dana Hull, Lauren Grush, Ed Ludlow, SpaceX warning investors that Elon Musk could return to U.S. politics. Max, before we let you go, is this more the lawyers covering themselves than it is an indication that Musk is going to have a new adventure?
I think more or less. And I think anytime you see something like this in a filing, obviously lawyers, as much as Musk has a stated view that is not super positive about lawyers, my assumption here is that this is lawyers and investor relations types trying to cover their bases.
But he signs off on it,
of course,
right? Yeah. So he's all in on this as well. Shares of Tesla, by the way, they're up about 1.8%. So one of our metrics on this. hey, be ready. Have your pager or whatever the heck ready, because we may call. I know.
The Max signal.
Your Starlink up and running, because we may reach out to you again. Of course, that is Bloomberg Businessweek senior reporter Max Chafkin. He's co-host of the Everybody's Business and Elon Inc. podcast and the author of The Contrarian.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Our next guest, certainly familiar to our Bloomberg audience, and has to take all of these big macro factors into account when thinking about the financial markets and figuring out what might be the possible impact. Great to have with us Monica Guerra. She's Executive Director, Head of U.S. Policy for Morgan Stanley Wealth Management, right here in studio. Good to have you here. There is a lot coming at investors and strategists and trying to figure out our way forward when there's still a lot of unknowns. So I am curious, first of all, with the pressure on Fed Chair Jay Powell, do you believe he could step down early?
I think it's up to him, right? The decision, there's no rule that says like he can't. In our view, we do think that he's likely to see the term out as only 8 more months, right? So this is important to keep at the forefront of this narrative. It's also important, I think, to Vicent and others to have stability within Treasury markets. So that is a critical factor in all of this.
So why does this Treasury Secretary, though, sometimes seem to put pressure on Fed Chair Jay Powell?
Well, that's because you have a president that's looking for a lower 10-year rate. You know, his background, you got to remember, he's a real estate guy, and having, more accommodative lending policies, right, is right in line with that. So,
but the Treasury Secretary is no stranger to Wall Street and understanding the importance of the Fed chair. I mean, for him alone, I think it's kind of interesting, or is it?
Which is why I think I want to agree with you in that it is interesting, but he's important in that he was a big voice of reason when it came to the initial tariff announcements, for example, right? He came in, he essentially coached the president through, especially when Treasury markets became unstable. So you have to remember that this is also something that is still top of mind for him. So I think what he's trying to do is balance policy priorities, what the president wants versus what is good for the markets.
In your view, what is more important to the markets, an independent Federal Reserve or clear trade policy?
Probably independent Federal Reserve, I would say, right, as far as being able to work with the committee, right, and actually, come up with the decision on the dot plot, right, of where they're going.
Would you say that independence has been threatened over the last few months by the president?
I wouldn't say it's been threatened. What you're looking at is a president who continues to voice his personal opinions. Powell has continued to do his job, right, the way that, he feels is the correct, order, right, in an independent fashion. You have the Supreme Court case that essentially created a carve out for the Federal Reserve specifically, so for further, adjudication if necessary. So I don't think this is a one and done, but I would really like to change the conversation to the tariff piece, because even though I think that having, a stable Fed is maybe more important for the economy, at least from a market's perspective, if we're thinking about tariffs, that's going to have a huge impact longer term potentially on the inflationary piece, which ties in to that interest rate argument.
And don't hate me because I want to go back there, because can the Fed chair and the Fed and the FOMC really determine the right policy before knowing exactly what all the tariffs and trade, you know what I mean? Like, until they know the specifics on the tariffs that are going to be imposed, like, can they really determine the right policy? And are they smarter to say, let's hold off a bit? Because if they're not as onerous and growth picks up and inflation picks up, right, they don't want to cut rates, raise rates, right? That would be maybe more problematic perhaps for markets.
Right, but I just want to say, in this discussion, you were talking about this desire to hold rates low. I think that if you're looking at the Fed, they're in a homeostasis right now because of all these factors, right? The data hasn't led them completely to a place where we have core economic weakness. We're seeing some initial softening in some of the data. We have to see how that all pans out. We have to wait till August 1st to get all of the tariff news in.
So on that, why would you say the tariffs haven't necessarily been inflationary at this point? Whereas 3 months ago in our studio, guest after guest was saying, just wait to see the inflationary effects of this. It hasn't happened.
So you had a pull forward in demand, right? You had suppliers ordering ahead of time. You had a full inventory restock. What we're seeing is that inventories are starting to, fall off. As soon as those new orders come in, right, at that higher level, that can be inflationary, right? It's going to be costs shared both with the company, right, the business, and the consumer. The other thing I want to note is that the dollar, right, is actually down about 10% from the beginning of the year. What that means on the import front is that weaker dollar means you are paying higher import costs. Doesn't matter what the average effective rate is, your import costs are now higher on a nominal basis. Right. So again, that is also inflationary, which is why I think it is, astute of the Fed to hold off and see where the data takes them.
So net, all of this in terms of what the longer term impact, Do you have a good feel about, I don't know, I feel like we go from day to day in terms of what comes out of the White House, which is fair and probably accurate. But I'm just curious, do you have a better feel of like, by the end of the year, there'll be some higher tariffs, but maybe not so onerous, and we'll start to see growth come back. Like, how are you kind of gaming this out?
So you're going to have a baseline of 10% on
no
any
matter
country,
what.
Right? On any country that you don't have a final deal with.
Which is a lot higher than what it was.
Right, a lot higher, right? So at least 3 times higher. So if we're looking at the average effective rate right now, it's about 12 to 15, depending on how you're counting. If you look at the most recent deal, I think with the Philippines, right, that's a 19% tariff just off of the 20. So while we're seeing some capitulation, right, and some negotiating downward, we could be at some of the same reciprocal levels that we saw on Liberation Day. I think that would be a surprise to the markets. You might get some interim volatility in response, but then it becomes an idiosyncratic risk and sorting through which sectors and industries could be most impacted.
Yeah, I mean, it's just, there's, as you say, right, each market, each country, each industry, it's really specific. And so there's a lot of detail in terms of figuring out the impact. Monica, thank you so much. Really appreciate it. Monica Garish, she is Executive Director, Head of U.S. Policy at Morgan Stanley Wealth Management, joining us here in studio.
Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. About 18 minutes to go until we wrap up the trade on this Tuesday, July 22nd. Carol Massar, Tim Stanovic here in our Bloomberg Interactive Brokers studio. Looking at probably another record for the S&P 500 if we continue at this level. 63.14, up about just shy of 9 points, 192 points higher on the Dow Jones Industrial Average. We've seen big tech under some pressure today ahead of big tech earnings getting underway. We'll get a couple of big ones tomorrow after the close. NASDAQ 100, Tim, right now down about 92 points off our best and worst levels of the session.
Let's see what Leo Kelly has to say about all this. He's founder and CEO of Verdance Capital Advisors. More than $4 billion in assets under management. He joins us from Hunt Valley, Maryland this afternoon. We're in kind of a weird place, I think. And I think Carol agrees with me here.
We're feeling kind of weird.
We're feeling a little weird because...
Just going to tell you.
We got the crypto market doing its thing. $4 trillion in assets as of last week. Bitcoin around a record, new record, close to $120,000 per Bitcoin. The meme stocks are memeing.
They're memeing.
It's a little crazy.
Yeah.
Yet tariffs are on the horizon here. And those are going to hit on August 1st unless something changes. What am I missing here?
Well, you're not missing that it's weird. It is. And it has been really for a few months, right? So April 2nd comes along and we have the tariff tantrum, which was shocking in of itself. I mean, imagine for a minute being surprised that Donald Trump is going to pull a hard line to negotiate with. That should be expected, not be surprised by it. And so we have this dramatic impact in the market, which is immediately turns around and we make new highs. I think the tariff thing gets done. What I think people have to do is take a step back and ask the question, what's important right now? What is it we should really be focused on? Should we be focused on whether the tariffs are 15% or 20%, or just that they're going to get done, and they will get done? Should we be focused on whether or not Jerome Powell is the next Fed president, or whether or not rates are going higher or lower? And if they go lower, will that stimulate inflation? We think it will. And in the intermediate term, are we bullish or bearish? Well, we're actually pretty bullish. There's a lot of investment coming to the U.S. We have earnings are starting to gain a little momentum. AI productivity is going to be significant. So there's reasons in the intermediate term to be bullish, and there's a lot of volatility, I think, headed in front of us in the fall. So yeah, it's weird because it feels a little scary in the very short run, and yet there's so many reasons to be bullish in the intermediate term.
All right, I just got to take a step back because I think last time you were on with us, Leo, was in mid-February.
Yes.
So what a long, strange trip it's been for U.S. stocks. So I'm just curious, you kind of walked us through some of this stuff, right, in terms of the imposition of tariffs by President Trump and backing off. What has the last 5 months been like for you and managing money for your clients?
Been interesting. So we've been holding cash in lieu of long bonds. So we've had cash. We have been extremely disciplined in rebalancing portfolios and not letting the hot stuff go too far and get too far out of kilter. So we had some dry powder, and to be fair, over the last couple of years, we've been waiting on volatility to put money to work. So when April hit, and we had this volatility and this pullback, we were very active in that moment. And so for us, this year has been active. It's been active from the standpoint of executing when the volatility has hit and then maintaining discipline as we go through this. And we're continuing to tell clients that more volatility is coming, but we're a little more bullish than we've been in years past. In years past, we've been a little hesitant to jump into the volatile moments. We're not anymore. We're buying into volatility because we do think the intermediate term looks pretty good.
Well, volatility, that was certainly something that we saw in April, but things have been really calm over the past few weeks. What opportunities have you seen of late, or are you still sitting on the sidelines waiting for things to move lower?
Well, I would say this. There's a couple of things that are going on over the last several weeks. One, valuations are starting to get stretched again, especially in the hot stocks, right? The big tech stocks. And so I think if the market continues to move higher at this pace, our next move would be to reduce again because our allocations will get out of sync. But there's still areas in the market to invest. Small mid-cap stocks still look pretty reasonable. International stocks made a big move. You might recall here last year we were big proponents of international stocks. We were been overweight. They've made a big run this year, so we're a little out of out of allocation on that as well. And in the private markets, there's still a lot of opportunity in private equity investing, private credit. There's some interesting energy plays out there. So we're always active in the markets, just not always in the S&P 500.
Well, that's what I was going to ask. I mean, increasingly everybody's been talking about the private markets. And so, for folks who focus on the public markets, you do wonder what you're missing, or you probably know what you're missing. Increasingly, are you, for your client base, Leo, more interested in the private markets, that's where you can kind of really juice performance versus the public markets?
Well, we have been for a long time. So we've been long-time players in the private markets, and we continue to put a lot of focus around that. I think there's some caution that we have to warn folks about when they start looking at the private markets. This democratizing private investments, especially with the new law that was just passed that allows these private investments to go into 401ks and IRA accounts. There's going to be folks chasing return. And private investing is great if you do a few things. One, you have rigorous due diligence. That's really important. Two, you have to diversify the portfolio over vintage and style. Too many times people get excited about one or two hot dots and they sound great and they have great past performance returns and they'll throw a lot of money. Well, in the private equity world, that can be very dangerous because it's illiquid. And you get stuck for a long, long time. It's not like a stock market that goes down and then pops right back up, and you can wait it out. With the private markets, you can be sitting on that for a long time. So I think folks have to be aware of the illiquid nature of it. So you have to allocate correctly, not just how much you put in private markets, but per deal and per vintage, meaning what year you're buying into. It takes, Carol, it takes 5 to 7 years to build a good private equity portfolio. So it's just not something you can just jump in and do.
No, I totally understand. And I mean, we've talked a lot about private equity, the difficulty in kind of getting out in the last few years. Right. So people are trying to figure out their portfolio. We got to run. Leo, good to talk with you again. Be well. We'll talk soon.
Always good to be with you guys. Thank you.
All right, Leo Kelly, he's founder and CEO of Verdance Capital Advisors. They've got about $4 billion in assets under management. Joining us once again from Maryland.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.